inflation really popped up right in the late spring last year, and we had a view that was very, very widely held in the forecasting community that this would be temporary. It was quite narrow. A limited number of factors were causing it, and there was a decent amount of evidence to support that view that it would be temporary or transitory, as we said. Certainly, we had 5 months of declining month-on-month, monthly readings of inflation, but we didn't see much in the way of progress on labor supply or on other supply side issues. Then in September, I'd say after Labor Day, we started to see, it started to become clear that this was both larger in its effect on inflation and more persistent. And of course, I said so on many occasions. And one of the consequences of that is that we moved the taper forward. We moved the taper forward, and it's a much faster taper than had been planned. So we've been adapting. I've been saying we're adapting our policy. So come to your real question. We got the ECI reading on the eve of the November meeting. It was the Friday before the November meeting, and it was very high, 5.7% reading for the Employment Compensation Index for the third quarter, not annualized, for the third quarter, just before the meeting. And I thought for a second there whether we should increase our taper. Decided to go ahead with what we had socialized. Then right after that, we got the next Friday after the meeting, 2 days after the meeting, we got a very strong employment report and revisions to prior readings and no increase in labor supply. And the Friday after that, we got the CPI, which was a very high reading. And I honestly, at that point, really decided that I thought we needed to look at speeding up the taper, and we went to work on that. So that's really what happened. It was essentially higher inflation and faster, it turns out much faster progress in the labor market. Really what's happening is the unemployment rate is seems to be catching up with a lot of the other readings of a tight labor market, 0.6 over one cycle. So that's really what happened. And, widely supported in the committee today. As you can see, unanimous vote, but beyond that, I think widely supported this move.
If I could just follow up quickly, you noted that the ECI was one of the things that made you nervous, but you also said earlier that you don't see signs that wages are actually factoring into inflation yet. And I guess I wonder how you think about sort of the wage picture as you're making these assessments.
Right. So, you quoted me correctly. It's so far we don't see wages are not a big part that we're seeing. As you look forward, let's assume that the goods economy does sort itself out and supply chains get working again, and maybe there's a rebalancing back to services and all that kind of thing. What that leaves behind is the other things that can lead to persistent inflation. In particular, we don't see this yet, but if you had something where real wages were persistently above productivity growth, that puts upward pressure on firms, and they raise prices. It would take something that was persistent and material for that to happen, and we don't see that yet. But with the kind of hot labor market readings, wages we're seeing, it's something that we're watching. And the other thing, of course, is rents, which are very important. Owners equivalent rent and rent. That's another thing which is very economically sensitive. Unlike the things that are causing the inflation now, this is economically sensitive, and so would be expected to move up. And so as some things go down, the question is, where will we be when we come out the other side of this? And we need to keep our eyes on those things.
Thank you.
Thanks. We'll go to Chris at the AP.
Thank you. Next year you could see growth slowing, and you could see some disinflation, particularly if the Omicron variant does spread more widely. Would you delay rate hikes in that situation, and how would you think about that? And also, how would you explain rate hikes if you do follow through in that kind of situation with inflation fading and growth slowing? How would you explain rate hikes to the public, particularly those who may still be looking for work?
Well, as you know, the SEP is not a plan. It's not something we debate, negotiate over, or really discuss in terms of what the right answer should be. People write down their assumptions, their assessment of appropriate policy based on their economic forecast. And so the median, what you're talking about, the 3 rate increases, that's the median of the committee. The median of the committee is also that growth will be 4%, and then unemployment will be 3.5% by the end of the year. So that's a really strong economy. And of course, if the economy turns out to be quite different from that, then so will the rate. No one will say, oh, we can't change our policy because we wrote something down in December. That no one's ever said that or will. It will. The actual rate decisions we make will depend on our evolving assessment of the forecast. So, for example, if the economy were to slow down significantly, then you would expect that would have an effect of slowing down rate increases. But we have to, we look at our 2 goals, maximum employment and price stability, and we make policy based on them, and not with respect to what we wrote down in a prior SEP.
Thank you. Let's go to Victoria Guida at Politico.
Hi, Chair Powell. I wanted to follow up on maximum employment. So, the new framework was basically designed, as I understand it, so that there was a de-emphasis on guessing where inflation would pick up because of employment, and basically you were going to wait until you saw the whites of the eyes of inflation, and that's how you would kind of know that you reached maximum employment. So I'm wondering, you've talked a lot about the different ways that you might measure maximum employment, but from what I understand, that's still basically the way that you know that you're there is inflation. So is that understanding correct? And how are those signals likely to be clear right now, given that you have inflation that's caused by these supply chain disruptions that might also lead to inflation in wages and those sorts of things? So how do you sort of tease out the signal of maximum employment?
Okay, so let me start by saying that the inflation that we got was not at all the inflation we were looking for or talking about in the framework. It really was a completely different thing. It was to do with, strong monetary policy and fiscal stimulus into an economy that was recovering rapidly, and in which there were these supply side barriers, which effectively led to, in certain parts of the economy, of what you might call a vertical supply curve. So, automobile purchases are very interest rate sensitive, and you would think demand would drive up the quantity of cars, but it can't because they don't have semiconductors. So that was a very different kind of inflation. This is not the inflation we were looking for under our framework at all. It's nothing to do with our framework, and the way we've approached it is really nothing to do with our framework. But come to maximum employment, which is really your question. How do you know? So I think you look at it at prices and quantities. If you want to look at maximum employment, you look at prices and quantities, and the main price you look at is wages. It's one of the things you look at, and it's. So I mentioned a number of the things. You could get to 20 if you wanted to easily, but labor force participation, the unemployment rate, different age groups of prime age labor force participation in particular gets a lot of focus. The JOLTS data get a lot of focus, and wages. That's really one of the great signals. The quits rate is another one. The quits rate is really one of the very best indicators, according to a lot of labor economists, because people quit because they feel like they can get a better job, and there's record amounts, historically high levels of that going on, suggesting again that you've got a very tight labor market. So on wages, that's the price indicator we look at to tell us, along with all the other data, whether we have labor market conditions that are consistent with maximum employment. And so that's how we think about it. But one of the complications is that, again, we've got to make policy in real time. So how do we think about that? If we think we can make labor, participation might move up. Let's say we knew that it would start to move up in 2 years, would we wait 2 years, or when inflation is running way above target? Probably not. So you have to make an assessment that what is the level of maximum employment that is consistent with price stability in real time is one way to think about it.
Just to kind of follow up on that for a second, if you do raise interest rates next year, and you're not certain whether you're at maximum employment, are you all going to point, when you raise interest rates, are you going to point to ways in which the labor market could still improve?
Which makes it one of the biggest, most important.
Yes, absolutely. I think whether or not we say we're at conditions, labor market conditions consistent with maximum employment next year, we would all be open and I think expect over time that the level of maximum employment that's consistent with price stability would increase further over time. For example, through increasing participation. So we would certainly, we would not in any way want to foreclose the idea that the labor market can get even better. But again, with inflation as high as it is, we have to make policy in real time. We've got to make that assessment in real time.
Thank you. We'll go to Olivia from Bloomberg.
Thank you. Good afternoon, Chair Powell, and thank you for taking our questions. I wanted to follow up on some of your earlier comments about labor force participation, and I wondered, what do you think needs to change in the economy?
The labor market is, by so many measures, hotter than it ever ran in the last expansion. If you think about it, you know, the ratio of job openings, for example, to vacancies is at all-time highs. Quits, the wages, all those things are even hotter. But what would it take for labor force participation to move up more? You know, that really, why is it low is the question. So there are a bunch of answers, and all of them probably have some, some validity. Part of it will be that people, for certain people, they don't want to go back in the labor force because either they're medically vulnerable or they're not comfortable going back while COVID is still everywhere. That's one thing. The lack of availability of childcare made for caretakers is certainly part of it, not just for children, but for older people. It has been pointed out by many that the stock market is high, people's portfolios are stronger. They may go back to being a one-income rather than a two-income family. The same thing with people's houses. People they have a mortgage and with leverage, and the house price increases, the equity they have in their home might have doubled, and they might reach the same conclusion. So and people have savings on their balance sheet because of forced savings, because they couldn't spend on travel and things like that, and also because of government transfers. So for all of those reasons, and it's hard to know exactly the part each of them plays, we have a situation where we've had a shock to labor force participation that is not unwinding as quickly as many has expected. And people, in effect, a good part of it is voluntary. People, and this is how they want to maximize their welfare, and that's certainly their choice. In other cases, it's something that will abate very quickly if and when the pandemic gets under control. It's a range of things. It isn't that the economy lacks stimulus. Usually in every other expansion, it's that there aren't enough jobs and people can't find jobs, and we're stimulating demand and trying to get demand to come up. That's not the problem here. The problem is a supply side problem, which what it would take to work it out, I think it's going to be time. And number one thing it would really be to have the pandemic get under control. That's what everyone would really like to see. What does the labor market look like in a world without COVID? That would be the thing that we'd really like to see. But it doesn't look like that's coming anytime soon.
Does that make you think we're going to end up at a lower rate overall?
Well, there's a demographic trend underlying all of this, and we actually got above the demographic trend at the end of the last expansion. So one would expect over time that labor force participation would move down, because in an aging population, the older people are, the lower their participation rate is. So you would expect that the trend would be lower, and that over time participation would move down. The question of how much we can get back up closer to where we were in February of 2020, and indeed for the year or so before that, is a good one. And I mean, what we can do is try to create the conditions. There's a lot of good for society when you have a tight but stable labor market where people are coming in, they're getting in the labor force, they're getting paid well. In the labor market we had before, we had the biggest wage increases were going to people at the bottom end of the wage spectrum for the last couple of years. There were just a lot of really desirable aspects of a labor market like that. Higher participation is one of them, and we'd love to get back there. But again, ultimately, we have the tools that we have, which are essentially to stimulate demand and also to control inflation. I mean, really, it might be one of the two big threats to getting back to maximum employment is actually high inflation. Because to get back to where we were, the evidence grows that it's going to take some time. And what we need is another long expansion, like the ones we've been having over the last 40 years. We've had, I think, 3 of the 4 longest in our recorded history, including the last one, which was the longest in our recorded history. That's what it would really take to get back to the kind of labor market we'd like to see. And to have that happen, we need to make sure that we maintain price stability.
Okay, let's go to Edward Lawrence at Fox.
Thanks, Michelle, and thanks for taking the question, Chair Powell. So I was looking at the census data there for estimated monthly changes on sales, and what you're seeing is fewer people spending at restaurants and drinking places, more people spending at grocery stores. You see electronic sales down 4.6% month over month. Also, department store sales down 5.4% month over month. How concerned, or what is your level of concern the consumer may be turning away from this economy or pulling back because of inflation, the virus, or something else? Thank you.
We see consumer expenses very strong in this quarter. I don't know, Edward, whether you're talking about more shopping online versus shopping in the store, but consumer demand is very strong. Incomes are very strong. Because people are going back to work and they're getting wage increases. Admittedly, some of the wage increases is being eaten away by inflation, but nonetheless, incomes overall are going up really significantly because of increased employment, and spending has been strong.
Okay, let's go to Mike at Bloomberg.
Mr. Chairman, the median forecast for inflation in this month's or this meeting's economic projections has been revised up significantly for 2021, but barely moved for 2022 and 2023. You've said you expect inflation to fall significantly. Is that because you're going to raise interest rates, or because the virus is going to fade and the effects are going to fade? In other words, is it a question of when, not if, you raise interest rates? And does it suggest that maybe your critics are correct and you might be afraid you're behind the curve?
Actually, I'm looking at the SEP here, and the median forecasts for core and headline inflation did move up by 0.4 each. So that's a significant, in an SEP, that's a pretty significant move up. It's based on both of those things, I suppose. I do think there's a broad expectation among forecasters, including our own, that the bottlenecks will alleviate sometime over the course of this year. If you look at where blue chip forecasts are, which is the group of well-resourced large forecasting operations with a long track record, they'll show inflation coming back down significantly toward the back end of next year. I would say, though, as well, that our policy should begin to have an effect. There will be a lag, but it should begin to have an effect on that as well. That's the most likely case. I guess what the thing I would want to say, though, is we can't act as though that's a certainty, and we're not going to act as though that's a certainty. There's a real risk now, I believe, that inflation may be more persistent, and that may be putting inflation expectations under pressure, and that the risk of higher inflation becoming entrenched has increased. It's certainly increased. I don't think it's high at this moment, but I think it's increased, and I think that's part of the reason behind our move today, is to put ourselves in a position to be able to deal with that risk. And I think we are in a position to deal with that risk. We need to see more data. We need to see how the inflation data and all the data evolve in coming months. But we are prepared to use our tools to make sure that higher inflation doesn't get entrenched. For one reason, as I just mentioned, it's one of the two big threats, the other being the pandemic itself, to getting back to maximum employment.
Let's go to Michael Derby, The Wall Street Journal.
I take my question. So as the Fed shifts towards an accelerated taper, I wonder what your read is on financial stability risks right now. I mean, these periods can be, it seems like the taper process has gone fairly smooth so far, but what do you see in terms of stability risks? Are there any parts of the financial sector that concern you right now? And are there any significant systemic issues that are on your radar, maybe from the cryptocurrency sector or something like that?
We have had now for a decade and more a four-part financial stability framework that we use so we can hold ourselves to the same kind of framework and not just treat each event individually. And there are four key areas: asset valuations, debt owed by households and businesses, funding risk, and leverage among financial institutions. So I would say asset valuations, I'm going to go really superficially here, but asset valuations are somewhat elevated, I would say. Debt owed by businesses, and households. Households are in very strong financial shape. Businesses actually have a lot of debt, but their default rates are very, very low. But nonetheless, it's something we're watching. Funding risk is by and large low among financial institutions, but we do see money market funds as a vulnerability, and would applaud the SEC's action this week. Leverage among financial institutions is low in the sense that capital is high. So overall, financial stability. That's how I would make an overall characteristic, but we break it down into those pieces. In terms of the things that we're looking at, it's the things we've already talked about to some extent. I would say cyber risk, the risk of a successful cyber attack, is for me always the most one that we would be very difficult to deal with. I think we know how to deal with bad loans and things like that. I think more a cyber attack that were to take down a major financial institution or financial market utility would be a really significant financial stability risk that we haven't actually faced yet. So I could go on with a list of horribles, but I think that's a decent picture of where I would start.
How about the cryptocurrency issues? Anything that worries you there that's going on in there in terms of, it's obviously a lot of time in that sector. Is that concern you at all?
I think the concerns there are not so much current financial stability concerns. I, of course, would support the views expressed in the President's Working Group report on stablecoins. Stablecoins can certainly be a useful, efficient, consumer-serving part of the financial system if they're properly regulated, and right now they aren't, and they have the potential to scale, particularly if they were to be associated with one of the very large tech networks that exist, and you could have a payment network that was immediately systemically important, close to immediately systemically important, that didn't have appropriate regulation and protections. The public relies on the government and the Fed in particular to make sure that the payment system is safe and reliable, as well as the dollar, and to provide a safe and reliable, trusted currency. So, but I do think those are longer term. In terms of the more the cryptocurrencies that are really speculative assets, I don't see them as a financial stability concern at the moment. I do think they are risky. They're not backed by anything, and I think there's big consumer issues for consumers who may or may not understand what they're getting, and there's certainly developments in the markets that are worth following, which are really not in our jurisdiction, but things like the kind of leverage that's built into them and those sorts of things is certainly worth watching.